If you've got a family trust, you've probably noticed a lot of accountants lately saying that you shouldn't have one, right? And I get why. The ATO have been tightening the rules around trusts for the last few years, and every year it seems like there's something new to worry about. I still use trusts for most of my clients and myself because I still think they're one of the most useful structures you can have as a business owner, but the way we run them has to change because a lot of the things people were doing 5, 10 years ago without thinking twice about it are now the exact things that ATO are looking for. So I want to walk you through what they're actually targeting now because most of it comes down to basic admin that nobody went back and checked. There's a deadline before the end of this year that you need to know about if you have a trust. Hold up. It's Andy from the future here, and this video was filmed in the past. Since the video was recorded, the federal budget came out. Quite a few changes. The first half of the video about what things ATO look for if you have a trust, still relevant, pay attention. But the second part of the video talking about distribution strategies, look, if old mate Albo and Jimmy Chalmers have their way, distributing to lower income beneficiaries and distributing to bucket companies through a trust would be off the table. But for now, the budget isn't law yet, and if you have a trust, the strategies in this video still work for the next 2 financial years, and if the proposed changes don't become law, then we're all good. I just want to flag that. Enjoy the video. Now, here's what's actually going on. A lot of the noise you're hearing about trusts right now makes it sound like the ATO has decided that trusts are a problem. And look, that's not really happening. What the ATO has been doing, and this goes back several years now, is looking at how a trust are being run in practice and comparing them to what the paperwork says. And for a lot of business owners, those two things don't match. Over the last few years, the ATO has been going through trusts area by area and tightening up what they expect to see. And each time they do, something that was kind of acceptable a few years ago might not be fine anymore. When I speak to business owners who have a trust, I always ask them the same question. Has anyone ever explained to you how your trust works, pros, cons, and what your obligations are? And most of the time they say no. They would normally sign where they were told to sign, and the structure has been running in the background ever since. So the issue for most business owners isn't that they've done anything wrong, it's that the rules have been firmed up. And unless someone has gone back and checked whether your trust still lines up with where those rules are now, you genuinely might not know. So let me walk you through the specific areas that ATO are focused on. The first one is Section 100A, and this is the biggest one. For the longest time, it was common for a trust to distribute income to family members on paper, maybe to a parent or a sibling who was on a lower tax rate, but the money would stay in the trust or flow back to the business owner. The distribution was real on paper, but the person named on the paperwork never actually received the money. The ATO has made it very clear that they expect the money to end up where the paperwork says it's going. And it can't just be a round trip. For example, you can't just distribute 30 grand to mum and then have it transfer it back the next day. The ATO will treat that as if it never happened because the money didn't genuinely end up with mum. And if it didn't, the ATO go back and reassess those distributions with the trustees, paying tax at the highest marginal rate. The second one is trust distribution minutes. Now, a distribution minute is just a document that basically says who is getting what from the trust at the end of the tax year. And every trust has a deadline for when this decision needs to be made by. Usually it's 30 June, but sometimes earlier, depending on what your trust deed says. Your trust deed is a document that has all of the rules for what the trust can and cannot do and when things need to be done by. So pay close attention to it. If the ATO can prove that your decisions weren't documented before the deadline, the trustee gets hit with tax at the top rate. And this has happened. There have been cases where the ATO challenged distribution documents and the tribunal agreed that there wasn't enough evidence to prove that the decisions were actually made before end of the year. The documents may have been dated at 30 June, but the tribunal looked at the surrounding evidence and they weren't convinced that they were made on time. The result, the trustee was getting assessed on the trust's entire taxable income at the highest marginal rate. And the third one is the family trust election. A family trust election is something your accountant may have lodged for you with the ATO, and it basically locks in which family members the trust is allowed to distribute to. In return, it gives you access to certain tax concessions. Now, if you have made a family trust election, and if a distribution has gone to someone outside of the nominated family group, even by accident, it triggers family trust distribution tax. Basically, a fancy way of taxing the trustee at, yeah, you guessed it, the highest marginal rate. And there's no standard time limit on this. The ATO can look back as far as when the first election was made. So if the wrong person received a distribution 5 years ago and nobody's picked it up since, that liability has been sitting there compounding interest the entire time. So after hearing all of that, you might be wondering, why would I still recommend trust for most of my clients? And I understand, because the jury is out on whether they're still useful or not, right? Some agree and some don't. But in my opinion, I still think trusts are one of the most flexible structures you can have as a business owner, but the reason I like them has actually changed over the years. Let me explain. Trust used to be seen as mainly an investment vehicle. You'd leave money in the trust, you'd invest it and take advantage of the tax benefits while the money grew. And that worked for a really long time, but as cost of living has gone up, especially since COVID, most business owners need more of that money in their own name just to cover expenses. So there's less money sitting in the trust to invest with, and the investment angle has become less attractive than it used to. Here's the thing, where I still see trust adding real value is in how they let you direct the flow of money. Think of it like an airport managing traffic. You've got income coming in and the trust gives you the flexibility to decide where it goes. Does it go to a bucket company where it's taxed at 30%? Does it go to family members who are on lower tax rates and genuinely need the money? Or does it stay in the structure for reinvestment? Without a trust, your options are way more limited. For example, if you're a sole trader, the money is yours and you're paying your full marginal rate on all of it. If you're in a company and you have a shareholder, which is an individual, it either stays in the company or it comes out to you. A trust gives you choices that neither of those structures allow for. But the flexibility only works if the way you're actually using the trust matches the rules around it. All three of the areas I just walked through come back to the same issue, which is the gap between what's happening in practice and what the ATO expects to see on paper. And when the admin hasn't kept up with how the rules have changed, that's where business owners get caught out. So, action point for you, have that conversation with your accountant. Make sure someone's gone through your trust deed, your distribution minutes, your family trust election to check that everything lines up. Now, if you want us to review your situation, I'll leave a link below where you can book a call with our team. On that note, thank you for watching this video, and if you enjoyed it, please leave a like, subscribe, and we'll see you in the next one.